okay. Telling people what the fees are, you should do so that you're being transparent. And the whole thing in the last episode is communicate, communicate, communicate. Over communication is better than uncommunication. Be transparent. And yeah, if you want to charge a 5% acquisition fee, tell everyone you're charging a 5% acquisition fee. Don't try to hide it. Don't try to swindle us. Just be upfront about it. If we want to work with you, even though you want to do that, then more power to you. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams. And as always, my good friend, business partner, and co-host, Frank Padlano. How are you doing, Frank?
Another good day.
So the last few episodes, we've been talking about vetting GP teams and sponsors. And so we have quite a few or quite a list. So this is going to be part 3 of that same series. And what we've discussed before in our first episode was some questions you should ask. How do they handle things? I would go into to listening to that episode if you want to learn more. I'm not going to get into it because we already recorded all of that. In our last episode, we started going into what are some of the excuses or inaccuracies, or I don't like to call them lies or deceptions, because generally people aren't trying to intentionally deceive or lie to you, but they will sugarcoat things and make things sound better than they really are. And so that's what we're going into again today. That's what we talked about last episode, and what we're going in this one. Um, we talked about some like track record inflation, due diligence on the team, due diligence on the property, exit strategy, stuff like that in the last episode. In this episode, we're going to go into some other, I guess, ways that a team may not be as transparent as they should. So, one way that I see is the fee structure and deception. So, with fees, typically you see fees like acquisition fee 2%, asset management fee 2%, um, disposition fee or refinance fee 1%, or whatever, capital event fee 1%. So a lot of times you see all these fees, but you don't really know what they mean, and they don't necessarily mean the same thing from one deal to another.
First thing I'm thinking about when you talk about fees, I would say that there is a necessity to have some fees. Okay, there's what the average person would charge. I know that I'm in a lot of deals that we spend 6 months. I burn through 10, 20, $30,000 worth of cash in order to get to a point in due diligence where we have to walk away. So when I think of like acquisition fees, I'm not saying that that's just paying for that one deal. That's offsetting the time, the effort, and the money that someone put into getting a deal done.
Yeah. And we've gone into how GP teams make money, and we've gone into the fee structure then as well. And this was quite a few episodes ago. So if you want to learn more, I would recommend listening to that past episode. But what I was going to get at is, yes, fees are needed. This gives the incentive to the GP team. Everybody's in business to make money. Well, most people are. Some people do it for the tax write off. Some people are just altruistic and want to help humanity. But for the most part, entrepreneurs and investors and business people are in business to make money. So fees are okay. Telling people what the fees are you should do, so that you're being transparent. And the whole thing in the last episode is communicate, communicate, communicate. Over communication is better than uncommunication. Be transparent. And yeah, if you want to charge a 5% acquisition fee, tell everyone you're charging a 5% acquisition fee. Don't try to hide it. Don't try to swindle us. Just be upfront about it. If we want to work with you, even though you want to do that, then more power to you.
Yeah,
But
as long
what
as it's
I
disclosed.
Yep. What I don't like is it's like, well, we're only taking a 2% acquisition fee. It's like, okay, I mean that sounds reasonable. That's like the industry norm, right?
Yeah,
But
2 or 3%.
is that acquisition fee on the total project, or is it just on the purchase price, or what is it? Is it purchase price, project, and all the equity and everything pulled in together? So I mean, there's a huge, you need to be upfront with it.
Well, just
And
like the concept, we only make money when you make money. Um, I mean, I've slipped and said that once or twice as well, but that's not always completely accurate. Sometimes I have to backtrack and say, well, there is an acquisition fee. You and I are pretty good that if the property is not making money, then we're not taking an asset management fee up front.
yeah,
Uh, there are people that need to because this is their full time job and they don't have anything else going on. But the concept is that my philosophy is that if the deal's not making any money and there's no distributions going out, you probably should not be taking any type of asset management fee for managing the project.
yeah,
It might accrue, but you're not taking it in cash.
yeah. I've seen deals where they raise 3 years of asset management fee right off the bat.
Wow.
So they're paid. So they're already raising enough to pay themselves for 3 years. But get this: this asset manage and this could be. I mean, it's neither here nor there what it's on, but their asset management fee was on the total equity raised. Okay. A lot of times, your asset management fee is calculated the same as your property management fee, which is on the effective gross income,
Yeah,
the
gross income.
EGI, which is all your rents minus all your losses plus all your other income. So that is how the property management fee is calculated. That's how probably about 90%, 85, 90% of asset management fees that I've seen are calculated. But this one deal, they raised it, or they were taking their asset management fee off of the total equity raised. And then they raised 3 years worth of it. So that kind of just like adds to their own pocket by that.
Well, not only that, but it reduces the overall return of the deal. It makes the deal less less financially with the incentive.
Yeah. Had I not had the underwriting, I would not have known. I would have assumed, oh, 2% acquisition or 2% asset management fee. I would have assumed that was based off of the EGI. But I looked into the underwriting and noticed, oh, wait, no, this is 3 years raised and it's based off of the total equity raise. So it's like as you raise it, then that increases your raised amount, which increases your asset management fee. So I mean, it's a circular loop in Excel that I saw. Um, Disposition fees. I mean, those I've seen them. They could be neither here nor there. You can ask the team what the reason is behind the disposition fee. It's like, well, we have a lot of work to do to refinance, or we have a lot of work to do to sell the property. It's like, I mean, I haven't had a property go full circle yet, or first full cycle, so I don't know what it takes to sell a property. But for this refinance, I mean, that's not much more work than it is just to run the property itself. Maybe send a
I've
few
had
more emails or something.
I've had full cycle, but we've never on no deal that I'm a part of do we have a disposition fee.
So but I mean, it's a common fee. It may be not as common as normal, but I mean, it is a fee and it is available out there, so people use it. But you just
Nice. So capital calls. I mean, obviously it's happening a lot lately.
yeah.
What are things they should be worried about with that?
The reasoning behind it. They always You should always know why you need to do a capital call.
Absolutely.
If they say it was always in the plan, then that plan was dead before it got off the
Come on,
got
I've
up.
never heard that one before. It was always in the
I
plan.
I haven't heard it before either, but it has come up like supposedly. So um some of it is just a small amount to handle unexpected repairs. This one seems kind of hokey to me because some unexpected repairs you don't. I mean, we've been able to handle without any capital calls just from like the cash flow stuff.
Well, I told you about that deal I had in Amarillo with the water main break underneath one of the buildings. But instead of doing a capital call, they did a dilution of the GP. So a little different.
That's
Um,
how you got into that deal, right?
yep,
Because you fronted the cash to fix the plumbing.
yep, which was
Okay.
fine. I was already an LP, and I really
Yeah.
wanted to be a GP, so just put another GP deal. Um,
Um, another one is trying to pressure people into giving cap or put um contributing to the capital call. It's like, well, everybody else has done it. You're the only one holding out. So if you don't do it, your shares are going to be diluted or whatever. So they're going to probably use scare tactics to get everyone in to contribute because one, if they don't raise enough to cover what's needed, then bad things can happen. They lose a property or something, lawsuits from residents if they don't have water type thing. So I mean, and then I've also contributed to a capital call once that they originally called a capital call, but then they turned it into like an investor loan or something. And so shares weren't diluted, but I'm guessing not enough people contributed, so they didn't want to dilute everybody's shares.
ah,
So they did it as a loan. So I mean, diluting shares is a huge pain because that's you're going to your CPA and they have to redo all the K1s and everything. And so if you can not dilute shares, that would be good.
so what's some other red flags?
Um, so one thing is if you're trying to get a hold of a GP team and they're never around or they're always doing something and they can't get to it or like and I feel like I'm like this, like I'm always traveling or I'm always doing something. This time of year right now is horrible for me. I mean, I just came back from a funeral. I just came back from two doctor appointments from Cook Children's in Fort Worth, which is 2 hours away. So I mean, every time I take a child there, at least takes a day to do that. Thanksgiving was a couple weeks ago, so I mean, it's like Thanksgiving, funeral, doctor appointment, doctor appointment. It's like the whole thing. It's like I'm always traveling and I'm not able to communicate, and that's not necessarily a red flag, but if that's their excuse every time you try to talk to them, that could be a bad thing.
Well, especially if you're not getting newsletters too. So yeah.
Yeah. Another thing is if you ask them a question and they say, "Well, just go to the portal. Everything's in the portal." It's like I've personally discovered that about 30 to 40% of all our investors never even signed up into the portal.
Yep. There was a deal that was paying distributions, and when I first signed up, I wanted checks. Well, they're not doing paper checks, so they had about 2 years worth of distributions just sitting there waiting to pay me, and I was worried that it was going to mess everything up. It didn't, but I had to just basically give my ACH information.
Yeah, so the portal we use, because I mean that's how we were logging everything. We were going in and setting up the people with the account, saying this is how much this investor had. And I was doing a lot of it manually, just from like all the paperwork, putting in the addresses if they didn't sign up, so that they would get paper checks. I prefer to do the ACHs, and I told them go to the portal, everything's there. But it's like for some reason they just didn't do it, and I had one investor who faxed me the PPM, so I had to scan it myself. While everything is on the portal, they didn't use it, so it's frustrating. Um, but if they say everything's in the portal, it's like that's not an answer. It's like, well, how do I even get to the portal? Because that's the next thing that they're going to say is I've never been there. How do I get there? So, or my invitation expired. I've seen that one too. Um, Another thing are like if they try to keep secrets from you, the GP team's keeping secrets from you. You ask them a question and say, "Well, we signed an NDA, so I can't talk about it," or our attorney says we can't talk about it, or whatever. So that's a big red flag because remember, as an LP, even if you're going to join the GP team, you are a business partner and you are privy to pretty much all the details going on with that deal.
That's
So
right. I've
that's
never heard
no
that one. That's like a big red flag for me. If they say their attorney told us not to comment or something, oof.
the
So,
only way I could see that happening is if an LP is suing the GP for some
yeah, that's a
reason.
little different. I agree.
Or we'll discuss that on the next capital call, or we'll put that out in the next newsletter. So I have one investor, and it's like never fails. Every time you and I sit down to do a newsletter, he's emailing me, "Hey, what's going on with the property?" And it's like we are right now writing the newsletter that we're about to send out in tomorrow or whatever. And so it's like I usually respond to him with all the information in the newsletter, but say, yeah, we're also sending out the newsletter tomorrow type thing. You've seen them because you get those same
Oh yeah, I get the
emails,
emails.
but it's like it never fails. Every time we're sitting down to do it, that's when it comes in. It's like we're on the same timeline. We just don't even know it yet. So,
There you go. That's funny.
um, what about you? Anything on your end? Any big red flags that you've seen communication wise or anything?
We've spoken about a few of them over these last three. Like I said, boots in the ground is super important to me. Um, Sometimes seeing big red flags on them not having enough experience. Like there was a deal where someone offered me, it was a $29.9 million deal that was actively being marketed in Dallas, and they came up to me to be a sponsor, and they were all excited because they could get it for 29.2. And it's like, guys, that doesn't excite me if it's not selling in Dallas to have a less than a 10% price drop. That's one thing, but to have a 3% price drop or less, that doesn't impress me much. And then they say it just shows their inexperience.
Mhm.
And then they say, oh yeah, it's wicked under market. It's $75 a month under market, and you and I both know how you can have many different two families that are all around the same. You could easily have $100 range for what a median or average two family is, depending on size of it and what's included in it and everything else. And for them to say it's way under market was just like one of those things. It's like, yeah, I like you guys, but you really don't know what you're doing.
Yeah. Yeah, that just shows an experience. I mean, I think what and I'm just this is an aside and me speculating, but when you're looking at a $29 million deal and you're taking 700K off, they're looking at 700K thinking about maybe single family residences which are maybe 100 200K, and so they're thinking of it like that versus a percentage where it's only what you said, like 3% off.
Yeah.
Yeah, so I mean, I think it's hard for inexperienced people to wrap their head around the numbers,
Well, I
the
was
big
also
numbers.
automatically out because I told them, I said, hey, listen, in my opinion, you guys should not be doing your first deal at 30 million bucks. I said, go find a $10 million deal. And then if we make mistakes, it's not as painful.
Yeah. So we've talked about a lot of the negatives on sponsors, how to find the bad things about them. So we do need to address the good things about them because there are good things. There are good sponsors out there. There are ones who do what they're supposed to. So what are some big green flags that you see
Um,
that makes you say, I want to invest with this team and continue investing with this team? And I know, let me guess, one of them is going to be boots on the ground.
yeah, but I wasn't going to say that one. The number one for me is being super responsive. So um, I'm a firm believer in the concept of the sundown rule, that you always try to get back to someone before the end of the day, or if not within 24 hours. So, I mean, you've seen that with me already. I mean, we're partners, we're friends, everything else. That's a big deal to me. That even though I'm in 10 deals as a GP, even though I own another 15 properties and have multiple other businesses on at the same time, if someone needs me, the goal is to answer their questions.
Yeah. Yeah. Be responsive. I tried to get within a day or two. Um, One thing that I've personally experienced is you have to know your roles. You have to know the people on your team and their roles. So if someone asks me a question, or maybe asks the whole team a question, but it's not like me specifically or directed to me specifically, I'm going to assume maybe somebody else in the team is going to do it. And then eventually everybody assumes somebody else is going to do it. And then nothing ever gets done. And that's can be a red flag. So you have to be responsive, even if it doesn't pertain to you, or and sort of, this is if you're going to be on a GP team. If it doesn't pertain to you, you need to say, bring it up to the team and say, who's going to take this? This is not my area of expertise, so I don't feel like I should do it, but somebody needs to. So
Yeah, no, that shows a strong team too. They don't always have to know um, who's going to do it, but they're willing to openly communicate quickly, and also people are willing to volunteer to help.
yeah,
I'm on teams where you don't hear communication from anybody because no one wants to be bothered.
yeah,
So it's like, no, I'll just stick my neck out. Whatever, it has to be done. Let's do it.
yeah. And what I don't like seeing is like one person having to do everything. There are going to be people on the team who don't, maybe not pull their own weight, or but they're not going to probably step up as much as the other people. And one thing is that one person can get burnt out if they're doing everything, and so it's
Absolutely.
good to spread it out amongst everybody. So another green flag is, and I sort of talked about this as a red flag, is if they don't give me their underwriting, that's a big red flag. But if they do give me their underwriting, that is a green flag. It's like, all right, you give me your underwriting, at least that's a step in the right direction. And let me go through your underwriting to see how you feel like this business plan is going to play out. And then I'm going to probably tear it to shreds, because that's what you and I do, is we look for the negatives and everything. And so we've analyzed a few underwritings that were actually pretty good before. So and you and I were like, hey, this looks reasonable, this looks good, type thing. But 8 times out of 10, that's not the case. We find flaws, and that's why we're looking at it, is to find the flaws, bring them to the attention of the team so that they can address them accordingly. So
Well, I'm looking to invest in needles and haystacks. So, I don't mind passing on 99% of all the deals.
yeah.
There's plenty of opportunities out there. Okay.
Hmm. Another green flag is if they're for if the if you're a LP looking to invest in a property, do you get to go and walk the property, or do they give property tours or whatever? That way, if they do a property tour, usually it's like a bus tour where they invite all the investors. That means you can meet other investors. You can share war stories about good and bad investments with that team or other teams. But you can also meet the team. Usually, and again, I'm speculating. If you get in on a team, you might only know the one person who brought you in. So this way you can meet the whole rest of the team and see how they work as a team, how the communication is between them, and stuff like that. So that's usually pretty good too. So
Um, Not everybody has had failures in this business, but I really like and appreciate when people talk and they're honest about things that have gone wrong in past deals.
mhm.
Um, I feel that there are people out there that won't be honest, or they want to hide the fact that they've lost money on a deal because they're worried that that means other people will never invest in them. And no, I mean, I've had people that specifically invest with me because they know that I've had failures and they've known that I've tried to improve since then. If you don't have, what do they say? No pressure, no diamonds.
Yeah,
If you don't have failures, are you working hard enough? This there is risk in the business. I'm not saying I want anybody to lose money, but you definitely have to think about being honest. That if you've had deals that have not performed as well, you let people know about them.
Yeah, and when you talk about the deals that haven't performed, one, it tells you of your resourcefulness on how to, did you lose everything or did you preserve the investor money but didn't get the returns you wanted, or what? So I mean, there's always, and we've talked about this before, there's no failure, only feedback. So I was like, you want to learn from your situation that you're in. And yeah, you might have a deal that's not as good. I mean, you and I are in a deal, two deals. One is doing pretty well. One is we have to keep putting money into it, but we haven't had to do any capital calls yet. And so it's like we're trying to be resourceful and making both deals successful, but it's like there's not, all deals are not created the same, and so you can't judge one deal off of a previous one. So
Another green flag in my eyes. We did a bus tour, Jason, in Texas, and we had someone that came and brought a binder of every deal they've been in, and talk about someone that's super experienced. And I was just excited to have him as an investor in our deal.
yeah.
You know who I'm talking about. I haven't seen him in a while, not since the bus tour. I haven't seen him, but just the concept of having experienced people that have faith in you, and they're willing to put money into your all the work that you're doing.
Yeah. And one thing about that binder is that binder's not all home runs.
Definitely not.
So I mean, some of them are strikeouts, but they're still in his binder. And so he understands not every deal is created the same. Some deals perform better than others. So I mean, it's a risk. We try to mitigate the risk as much as we can, and that's why you invest in the team and how well they mitigate risks. But I mean, overall, it's still a risk. And so, what's your risk tolerance? And did we talk about risk tolerance in a previous episode, or does that sound like a new episode?
We'll have to look. I
Definitely,
think we did.
we might have already talked about risk tolerance. So that pretty much wraps up on what we how we vet GP teams. If you're going to be a LP, a limited partner, or if you're going to be part of the GP team as a capital raiser slash investor relations guy, or um, any other role. Maybe you have to come in as an emergency plumbing fund person to be on a GP. Who knows? So
Yeah, I
we
mean,
have
in
it.
the end, when I look at deals, I look at the team first, the market second, and the deal third. So that's just my normal standard way.
I look at the team first. Um, I'll look at the deal at a glance. I'll look at the market, and then I'll go back and deep dive into the deal. So I mean, if I'm looking at the team and I'm looking at a deal that has dismal returns, I'm probably going to be turned off and not even look further. But so,
And then,
um,
like we said before, there's so many opportunities out there that if you don't like something about it, yeah, there's nothing wrong with moving on. But just be honest about it. Don't just ignore the person. I have people that are going to follow up until you tell them no, and it's like, well, I didn't want to say no because I didn't want you to be mad at me. It's like, no, I'd rather you say no and move on. I'll work with someone else that might have the appetite for it instead of wasting my time trying to follow up with you in some ways. I'm still going to like you after this. Just say no and we'll move on.
yeah, that's one thing that I don't like, and this is another topic altogether. Is you get someone who's either not responding. I guess if they're not responding, it's more or less a no. But if you say, "Well, I'm still thinking about it," or I have to talk to my wife or whatever, you already know the answer is no, but you're giving excuses. That only hurts the person who's trying to raise capital, because if you're a no, then you check them off the list and they don't have to keep bothering you, which is good for you, and it doesn't waste anybody's time.
Yeah, that's what I say.
So um so I think this was a pretty good three-part series on how to vet a GP team. If you have any other ideas or comments, you can drop them in the comments below or reach out to us at ironcladunderwriting.com or on YouTube or LinkedIn or whatever platform you're listening to this on. Um, and we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, Make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.